Hello everyone, this is Sir Abdullah from Academia UK. Today I'll be going over paper 2, which is AS level accounting paper 9706/22. This is the paper from February March 2023. I know most of you have been looking for this paper, so I have tried to make a solution video for most of the questions. This is question 1, which is on partnerships. So let's get started with the video. Hello everyone. So today we have this accounts AS level paper. This is the most awaited paper from February March 2023, and I'll be going through all the questions and solving them side by side for your better understanding. As we all know that the syllabus has changed a bit this year, but the major change has been in the paper pattern for paper 3 and paper 4, which was previously paper 3. So without any further delay, let's just start off with these questions. As we know that in your AS paper 2, you have to answer all the questions, so there is no choice. The very first question that they have given to us is for partnership. So the question is simply saying Nibras and Raif are in partnership, they own a car hire business. So technically this is not a manufacturing business, we're talking about a service sector business. So obviously the accounts can be a bit different because we won't be having any cost of sales, or let's say any manufacturing cost attached in this. So the following balances were available. They have given you allowance for recoverable debt, cash at bank, capital accounts, current accounts, drawing. Okay, in the current account we can clearly see that there is a debit balance for Nibras, so we'll keep that into mind when we're making whatever is required. Insurance, interest on loan. So there is this loan from Raif. So basically we will be paying some sort of interest to Raif because he's the partner. There is motor vehicle expenses, motor vehicles, premises, rent receivable, repairs, maintenance, trade receivable. So nothing that new or nothing so out of the ordinary. Looking at the further information, they are saying that interest at 10% per annum on the loan from Raif is accrued for the last 2 months. Okay, so this is something that we noticed up there, that there is loan from Raif. So they have mentioned that interest at 10% per annum on the loan from Raif is accrued for the last 2 months. So if we can simply calculate the loan from Raif is 9,000, so that means that 10% for 9,000 will be 900. So out of that 900 per year, so that 900 is for 12 months. So out of that they're saying that is accrued for the last 2 months of the year. So basically out of this 900, 2 month loan, 2 month interest is not yet paid. However, in our income statement we will take this 900 as the whole, as that is the interest that is payable. Moving on to further information, insurance payments covered the period 1st January to 28 February 2023. Monthly insurance costs have remained unchanged during this period. So the insurance payments amount that is mentioned over here is 15,400, and this is covering the period from 1st January to 28 Feb. So obviously this is more than 12 months. We are closing on 31st December 22. That means that we have paid 2 months in advance for this insurance payment. So basically this amount that they have mentioned over here, this amount is for 14 months. So we can simply divide it by 14 and take 12 months out of that, or you can easily make this 12 over 14 to see that what will be the amount for the 12 months. Now moving on, we have the partners have agreed that the allowance for irrecoverable debts is no longer required. So the allowance of irrecoverable debts is no longer required. That means that they are removing this allowance for irrecoverable debt. Just to remind you guys, allowance for irrecoverable debt is same as your provision for irrecoverable debts. Yeah, provision for doubtful debts. So instead of using the word provision, they're just using allowance for irrecoverable debts, and they are removing it this year. So that means that when they're removing it, so technically this is 380, so this is now being reduced to 0, and we will be treating this as other income. So whenever you have an allowance for doubtful debt that is being removed, so we always treat that as part of other income. Rent receivable by partnership is 550 per month, so that will be multiplied by 12 to get the total year's rent. Part of the premises have been rented for the full year. Okay, motor vehicles are to be depreciated at 25% per annum using the reducing balance method. So we'll simply take the motor vehicles cost, deduct the provision for depreciation, and we'll get the net book value. So the net book value will then be multiplied by 25% to get the depreciation, and then premises are to be depreciated 2% per annum using a straight line method. So starting off with the question, they're asking you to prepare a statement of profit or loss for the year ended. So the very first thing that we're gonna start off with is the revenue that they had given to us. So in the question, the revenue has been given to us as, so there is this revenue from car hire 88,300, and we just simply start with that. So revenue 88,300. Now because this is a service sector business, we're not producing anything, so we don't have any opening inventory or purchases or cost of manufacturing. So simply after revenue we will be adding our other income to it. Now remember, we had some sort of rent that we were receiving. So there is this rent receivable by a partnership, and this is basically a form of income. So rent receivable is 550 per month. So that means that for 12 months this will be 550 multiplied by 12. You can always show your working in this small bracket. So we know that this is 550 by 12. This gives us a value of 6,600. And also there was other income in the form of this allowance for irrecoverable debt, which they were cancelling out. So previously, let's suppose this provision for doubtful debt was 380. Now they have completely finished this. So this point 3 was saying the partners have agreed that the allowance for irrecoverable debts is no longer required. So when it's no longer required, that means they are just reducing it. We will be treating it like a reduction. So now it is 0, so that means it has reduced from 380 to 0. So we need to record that as our other income. So allowance for irrecoverable debt, you can write reduction in irrecoverable debt, yeah, allowance in irrecoverable debt. So I am just writing it as reduction in bad debts, and this is 380. Okay, so once we add these two up, we get a value of 6980. So 6980 is added into our revenue, and that will give us a total of 95280. Okay guys, now simply after this we'll take down a list of our expenses. There were a lot many to that were mentioned up there. So looking at these one by one, we can start off with insurance. So okay, and in insurance they had mentioned about that insurance payment covered the period 1st January to 28th February. Our year is ending on 31st December, so we need to take insurance amount for only 12 months. So we know there is a prepayment of 2 months, so you can do this two ways. You can divide this total amount by 14 and take multi take 2 months deducted from this, or simply take 12 over 14 for this amount, because this is showing the total 14 months amount. So this insurance amount was 15,400, right? So we take 15,400 and we multiply it by 12 over 14. Why 12? Because we only need to take for 12 months, whereas this amount is given for 14 months. You can also take 2 months prepaid and then deduct it, and the value that we'll get over here is 13,200. Once this is done, the next expense we can write down motor vehicle expenses, which was 12,420. There was no change in that, so we'll simply put that as it is. So motor expenses, this was 12,420, 12420. I had repairs and maintenance 8270. There was no change in that, so repairs for 8270. We have done rent receivable. We have loan from Raif. There is interest on loan from Raif, so interest is also an expense. So interest on loan from Raif, loan from Raif 750. There is loan from Raif which was 9,000 into 10%, and we calculated that 900 is the interest that we will be taking in our income statement, because that is basically what you take due to accrual and matching concept. So although it has not been paid completely, we will be recording it as a whole for 12 months. So this is 900 for the interest. I think so I also saw some wages and salaries. So wages and salaries 18,460. There was no change, nothing was mentioned about wages and salary. So wages are 18,460, and then we'll come to the part of depreciation. So we had depreciation for motor vehicles, which was on a straight line method. No, this was on reducing balance method, and there was premises, which was on a straight line method. So to take the reducing balance method, we take 144 minus 33,200 to get the net book value, and then multiplied by 25%. So for depreciation of motor van, we know that we have the cost that was 144, and this was minus 33.2. I am just not writing the zeros, so, and this is basically we take 25% for this. So the depreciation amount will be 27,700. Because this is the reducing balance method, that's why we're doing this on net book value. On the other hand, the amount for premises was completely on a straight line method, and the value given for premises is the depreciation rate is 2%, the cost is 220,000. So we simply take a 2% of 220,000 over here. So for premises, 220,000 into 2%, and this will give you 4,400. Okay, so this is 4,400. Now we simply add all our expenses. So 13,200 plus 12,420, 8,270 plus 900 plus 1,8,460 plus 27,700 plus 4,400. This will all add up to give you 8,5,350. Okay, so once we have all these expenses, we know that we'll be deducting it from the income that we calculated up there. So 95280 minus 85350 will give you a profit of 9930. So this is a positive amount, so we know this is profit for the year, 9930. So this was pretty simple to do. The only confusing parts over here was this allowance in doubtful debt. So they were finishing it, so they already had it at 380. So when they're finishing it, that means they're removing it. That means it's a reduction in your doubtful debt. So we will be adding that in our other income. And there was a part about the insurance payment. So this was paid for 2 months in prepaid, so we mentioned that. Otherwise this was a very plain simple calculation for profit for the year. So now moving on to the next part. Okay, now moving on with this question, they've given you some more further information, and part B is asking you to prepare an appropriation account. Okay, one thing that I like to refresh over here is that previously the partnership topic did include retirement and addition of partners in your AS syllabus, but this is the first time that it has been removed, and now you only have further appropriation account, and there is no actual retirement or addition of partner where we had to prepare that revaluation account. So this is just a simple appropriation account for Nibras and Raif. So they are saying Nibras and Raif agreed the following terms for the appropriation of profits and losses. Interest on capital is to be 10% per annum. Nibras to receive a partnership salary of 6,000 per annum. Remaining profits and losses to be shared in the ratio Nibras Raif 3:2. So whenever we have this ratio in the form of 3:2, we know that we'll take this as 3/5 for Nibras and 2/5 for Raif. So starting off with the appropriation account, we remember that we had a profit for the year that was 9930. So starting off with the profit for the year 9930. So profit, and this is 9930. Now the very first thing that we'll do in this appropriation account is that we'll deduct the interest on capital. So interest on capital is deducted from the profit, so we will less the interest, and this interest on capital is 10% per annum for both the partners. So we'll go back to our original sheet, the data, and over here we can see that the capital accounts were given for Nibras and Raifs. So we simply take 10% of 180,000, which will be 18,000, and then 10% for Raif 120,000, so that will be 12,000. So interest on capital is calculated on the balance of your capital accounts. So we will be deducting this from our profit for the year. So interest, we had Nibras and Raif. So if I remember it correctly, that was 18,000 for Nibras and it was 12,000 for Raif. Basically the total capital was 180,000 and we are taking 10% on that 180,000 as your interest on capital. So we're done with this first point. The second point is saying Nebraska will receive a partnership salary 6,000 per annum. Always keep in mind sometimes they write per month, so when we're making it on a yearly basis, so you have to multiply it by 12 months, but over here they have given you per annum, so we'll just directly take this salary, and salary is also deducted, so we will simply write as salary, and this salary is going to Nibras only, so we can write salary to Nibras, which is only 6,000. And then we have remaining profits and losses to be shared in the ratio Nibras and Raif as 3:2. So let's simply deduct these. So this will add up to 18 plus 18,000 and 6,000. This all adds up to 36,000. Okay, now I can see that we are already seeing a loss over here because the profit for the year was only 99.30, and if we deduct 36,000 from that, so we're getting a value of negative 26070. So now it's either profit or loss that needs to be shared, so we can see that over here we have a loss, so sharing this loss in the ratio 3:2, we take 26070 and multiply it by 3/5 for Nibras, and if we do that, so this was 3/5 of this 26070, so this will be 15642, and for Raif it was 2/5 for the same, so 26070 multiplied by 2/5, we get 10428. So this is how we're recording this share of loss between the two partners. Now in some questions you may be getting a profit, but in some questions you may be getting a loss, so when there is a loss we divide that by their profit sharing ratio, and the only effect will be that now obviously this loss will be going on the debit side of their current account if you have to make their current account, right? Because when there is a profit, so you credit it on your current account because obviously that's a gain, but over here because this is a loss, so this share of loss will be debited in their current account. Now most of the time the next part after your appropriation account is your current accounts, but over here they have given you further information, and they're saying the partners would like to know what difference it would have made if they had operated without a partnership agreement during the year ended 31st December. Calculate by how much Nebraska's current account balance would have been different if there had been no partnership agreement. So like I said that this is something about the current account, but they're actually asking you that what effect there be on the current account if there was no partnership agreement. Now, one thing that we know, that when there is no partnership agreement, we do not have anything like salary, anything like interest on capital. There is also equal division of profits and losses. And like over here in this question, we did see that there was salary and there was some interest on capital that they were receiving, so that effect will not be uh, there. And for that we'll need to make changes to the current account. Now remember, in the balance they had mentioned us the current account value, so we're only referring to the value for Nebraska. This is 5950, and this is the one that was on the debit side. So you can simply do this by making a current account. For Nebraska, we'll first make a current account with the partnership agreement, because they're actually asking you for the difference between the two. So let's just draw one with the partnership agreement. So if this is the current account for Nebraska, we know that there was a debit balance of 5950. So this is 5950 on the debit side. So let's say this is our balance, the opening balance. And then he was receiving a salary and he was also receiving interest. So Nebraska was getting interest of 18,000, Nebraska was getting a salary of 6,000, and we'll simply put those things on the credit side. So there is salary, so everything that is increasing the capital is credited, and there was interest on capital which was 18,000. Then he was also sharing the loss. So Nebraska's share of the total loss was 15642. Now because this is a loss, that means this would have been going on the debit side. So let's say the share of loss was 15642. And for one last time, we'll just look at all the balances again, because there is always some amount of drawings that also needs to be entered when we're making the current account. So just checking for the amount of drawings that they have made, and we can see that there are drawings for Nebraska which are 19,200. So they will also go on the debit side. So drawings 19,200. Now simply you add up the sides to find the closing balance. I can see that this side will be the greater side, so we'll simply add this up. 5950 plus 15642 plus 19200. So when 40792, we write the same over here, 40792, and deducting that from 66,000 and 18,000, we get a closing value of 16792. So this would have been the value if with the partnership agreement. So that means that the balance on current account would be 16792. This is the one with the partnership agreement, because remember the agreement is where they can decide on the salary, and they had interest on capital and all that. Now the question was asking that calculate the difference if between having the partnership agreement and no partnership agreement. So let's quickly calculate a current account balance if there was no partnership agreement. Now for that we know that the current account value will stay the same. This was a negative value in the starting. This was the amount that they had at the opening balance, which was, now first I did this using the current account format. Let's just do a simple addition subtraction format for this no current account, no partnership agreement value. So I take the opening balance of 5950. This is negative, and again the drawings will stay the same, so we can further reduce the drawings from here, which were 19,200. However, now there will be some changes in this share of loss. Now remember, because when there is no partnership agreement, that means there will be no interest on capital that is given to them, and there is no salary. So technically out of this 9930 profit for the year, they won't be giving out these things, and this is something that was bringing their profit and turning it into a loss. However, there was this interest on loan that they were paying, and we know that when there is no agreement, we charge a 5% interest on loan. So there is a 5% interest on loan given. So there is loan from Raif, that is 9,000. So as we know that in when there is no partnership agreement, we charge interest of 5% when there is any interest on loan from the partners. So over here we have this loan from Raif, which was 9,000. So if we take 5% for this 9,000, that will give us 450, right? However, they were charging an interest of 10%, and this was deducted from their profit, which we did over here when we were making the income statement, and this interest was deducted from this profit. So technically this 9930 is excluding this interest. So what we can do when there is no partnership agreement, so technically this 9930, we can add back the interest which we were deducting over there, and we can deduct the new interest, which is 450, because this was according to that 10%. So we are adding that back because that will not be there when there is no partnership agreement, and we are adding this 450 because this is 5% of 900, which is there because when there is no partnership agreement, this is stated that you need to take interest on loan as 5%. So if we take a net effect, so 9930 plus 900 gives us 10830, and minus 450 gives us a value of 10380. So technically this is basically the profit that would have been there if there was no partnership agreement. And if we divide this profit, we can simply divide this profit on a 50-50 basis, because in no partnership agreement the profits and losses are divided equally, right? So if we take this share of profit, so the profit that we calculated was 10380, and we simply take one half of 1030. So because we're only making this for the brass, so we get a value of 5190. And with this minus 5950 minus 19200 plus 5190 gives us a closing value of 19960, which is negative. That means this is a debit balance. Now, going back to the question was actually asking how much is the difference if there was no partnership agreement. So with we now have both the figures for our current account balance with the partnership agreement, which is 16792, and our current account balance with no partnership agreement, which is, so we can see that the difference between these two is that was also negative and this is also negative. So 16792, and you're getting a difference of 3168. So we know that the current account balance will be decreasing by 3168 if there was no partnership agreement. So guys, moving on to the next part, additional information is given. The partners had considered charging interest on drawings as part of their agreement. Required to state one reason for including interest on drawings in a partnership agreement. So this is basically the theory parts for this question. So they're asking you for one reason why a partnership may include interest on drawings. Interest on drawings is usually included in a partnership agreement to discourage or prevent partners from making excessive drawings, because we know that when they withdraw money out of the business, so there will be less money available in the business for them to uh, use in their operations. So main reason for charging interest on drawings is to discourage partners from drawing excessive amount or drawing more amount of money. So you can simply give that in a statement. Next part is saying state the double entry for recording interest on drawing. So basically interest on drawing is something that the business will be receiving from the partner, and that is what is included in the appropriation account. So because interest on drawing is something that the business will be receiving, so that is a form of income, and income is always credit natured, so we will simply credit the income statement appropriation account. So the appropriation account is credited and the partner is the one who is giving that interest. So the debit entry is in the partner's current account. So whoever is giving that interest on drawings, his current account will be debited by that amount. So simple entry will be the journal entry on the debit side will be debiting the partner's current account, and for credit entry will be making the entry in income statement or appropriation account, because your interest on drawing is an income for the business. Moving on, additional information further states Nebraska and Raif would like to expand their business, but they require additional finance. They have considered two options. Option 1 is that Nebraska to introduce additional capital by selling some personal investments, and option 2 is to arrange a bank loan. So advise the partners which option they should choose. Now, whenever we have a theoretical question that is based on sources of finance or asking you to justify which source of finance will be more useful in the situation, the very first thing that you need to see is that what's the main purpose of that finance. So over here they're clearly identifying that they want to expand their business, which would require a lot of capital expenditure. So that means we are talking about a large amount. Then secondly, the two options that are given over here, so we can simply use the advantages of both the options and also mention the disadvantage that is attached to that option. So option 1 is to introduce additional capital by selling some personal investments. Now, if he is adding more capital to the business, so obviously that would mean that he will have more stake in the business. Now, this is definitely a good permanent source of finance, and it will not really affect their profit, because in case of a bank loan they will be paying interest. So as compared to option 2, there is no interest, so that is a positive, and this is a permanent source of finance, that is a positive. And we can say that he will, but however he is actually selling his own personal investments in order to do that, right? So that can be a drawback or something that might be limiting Nibras from making that decision. Or in other words, you can also say that Nibras might want to take more role as more decision making powers, because now he will have more money at stake, so that can be also a problem. However, that thing again holds that it might be possible that the personal investments are not sufficient, so that money may not be sufficient to uh, finance their expansion. So however they want to expand, that money may not be enough for that. And another negative to this can be that Nibras may expect more profit share or more ownership or more share of profit. And option 2 was arrange a bank loan. So obviously when we're talking about bank loan, so bank loan uh, always comes with a cost of borrowing, which is the interest. So that is the one huge uh, drawback attached to the bank loan, and that is something that can stop them from uh, making that decision or choosing bank loan as a source of finance. So when they will be paying interest, that will reduce their profitability, and when that profit will be reduced, they will be getting lower share of profit. Along with that, bank loan will also require some sort of collateral that they need to provide, or security that they need to provide to the bank in order to obtain a large sum of money. However, on the positive side, they get a good amount uh, right away, which they can use for their expansion purposes. So we do know this is required for expansion, so we can assume that they will be doing capital expenditure, which requires huge sum of money. And at the same time, this partnership will also, again, a disadvantage can be that this is a liability that they will have to pay back in the end, uh, after 2 years, 3 years, 5 years, whatever their agreement is. And now, the question was asking advise the partners which option they should choose. So, in my opinion, I can justify that they can try to do it through option A. How? Because if they go with option B, it will be affecting their profitability and their liquidity position, because their liability will be increasing, their profits will be reducing. They are already experiencing some low profits. So in such a situation, if they have to give more loan, will the partnership be able to sustain or operate in the long run? That can be a problem. So the best thing to do in this is that you can choose any option whichever you feel is more suitable, as long as you're justifying it correctly with any relevant points. So this was the last part for this question 1. So guys, this was question 1 from February March 2023 paper. I'll be doing further questions. You'll find them in my other videos. Please post a comment and leave any queries that you have. You can also post your request and I'll try to get back to them as soon as possible. Thank you.